Imagine you walk into a bank tomorrow and say, I have no debt. I don't have a car loan. I don't carry a credit card balance. I don't have a mortgage. And I never pay interest. You'd think the bank would be impressed. But from the bank's perspective, you're not exactly the dream customer. Because here's the uncomfortable truth. Banks don't make most of their money when you save money with them. They make money when money moves through their system. And debt is one of the most profitable ways to make that happen. Every time you borrow $30,000 for a car, $300,000 for a house, or even $2,000 on a credit card, you aren't just buying something. You're creating a stream of future payments. And someone gets paid every time that stream continues. That's why banks are willing to offer you credit cards you never asked for. Why they'll spend millions advertising mortgages. Why your credit score can determine how expensive your life becomes. And why the financial system has spent decades making borrowing feel less like a dangerous financial decision and more like a normal part of adulthood. But there's a catch. The bank wants your debt to last. You want your debt to disappear. And understanding that difference completely changes the way you should think about borrowing money. Because banks aren't necessarily trying to make you poor. They're trying to make your money predictable. And sometimes those two things can overlap. Most people think a bank sells money. That's not really what a modern bank does. A bank sells access to money today in exchange for payments tomorrow. Think about a mortgage. Suppose you borrow $300,000. You don't hand the bank $300,000 and walk away. Instead, the bank gets something much more valuable. A contractual promise that you'll keep sending money back for years. Principal, interest, fees, and potentially other financial products attached to the relationship. From the bank's perspective, that's incredibly useful because predictable cash flows are valuable. If you borrow money and pay it back immediately, the bank earns relatively little interest. But if you borrow money and repay it over 10, 20, or 30 years, now the bank has a long-term relationship with you. And this is where the incentives become interesting. The bank isn't sitting there thinking, how can we destroy this person's financial future? It's thinking, how can we lend money at a rate that compensates us for the risk? The longer the loan lasts, the more opportunities there are to collect interest. And that's why debt duration matters. Let's make this painfully simple. You borrow $20,000. The bank charges you interest. You make monthly payments. Part of every payment reduces the amount you owe. Another part goes to the bank as interest. That interest is the price you pay for using someone else's money. And from the bank's perspective, it's revenue. This is why the phrase minimum payment is so important. A minimum payment isn't designed around what would get you debt-free as quickly as possible. It's designed to keep the account current while allowing the balance to remain outstanding. That's not automatically sinister. A minimum payment can be useful if someone temporarily needs flexibility. But psychologically, it creates something powerful. It makes a large purchase feel small. A $3,000 purchase sounds expensive. Only $89 a month sounds manageable. And that difference is enormous. Because your brain naturally focuses on the immediate monthly sacrifice. The bank is focused on the total stream of payments. You're thinking, can I afford $89? The bank is thinking, how long will this balance remain outstanding? That's the first major difference between how consumers and lenders think about debt. Consumers think in monthly payments. Lenders think in cash flows. And here's where debt starts to resemble something you already understand. Subscriptions, Netflix, Spotify, cloud storage, software, phone plans, gym memberships. Each individual payment can feel small. But small recurring payments are incredibly powerful because they change how we perceive cost. Debt can work the same way. Instead of asking, can I afford this $5,000 purchase? You start asking, can I afford another $150 a month? And suddenly the purchase doesn't feel like $5,000. It feels like $150, then another $150, then another. And eventually, you've built an entire financial life around monthly obligations. Car payment, phone payment, credit card payment, student loan payment, mortgage payment, streaming subscriptions, insurance, buy now, pay later payments. Nothing individually feels catastrophic. But together, they can consume most of your future income before you even receive it. And that's the real danger of debt. Debt doesn't just cost money. It commits future money. Now let's talk about one of the most profitable forms of consumer debt. Credit cards. Credit cards are fascinating because they don't just change how you pay. They can change how you spend. When you use cash, the psychological connection is immediate. You hand over money. It's gone. With a credit card, the purchase and the financial pain are separated. You buy something today. The bill comes later. And if you don't pay the balance in full, the purchase can continue generating interest long after you've forgotten what you bought. That $700 television doesn't feel like a $700 decision anymore. It becomes a monthly payment. And this is where banks have an enormous advantage. They know something about human behavior. People are very good at justifying small payments. $30 doesn't sound dangerous. $70 doesn't sound dangerous. $120 doesn't sound dangerous. But $30 here, $70 there, and $120 somewhere else can quietly consume hundreds of dollars every month. And the bank doesn't need you to make one gigantic mistake. It can make money from thousands of ordinary decisions. Now here's the part people often misunderstand. Banks don't necessarily want you to default. In fact, quite the opposite. A borrower who never pays is a problem. The ideal borrower is something much more boring. Someone who borrows, pays consistently, carries manageable balances, and keeps using the bank's products. That's the sweet spot. The bank wants the interest, but it also wants the relationship. Because once a bank has your checking account, savings account, credit card, mortgage, car loan, and investment products, switching becomes harder. You become what the industry might call a valuable customer relationship. And that's why banks don't just sell loans. They sell ecosystems. You might walk in for a checking account. Then you get a credit card. Then a mortgage. Then a home equity product. Then an investment account. Then insurance. Each individual product can make sense. But together, they create something much more powerful. Financial dependency. And here's where we need to be careful. Because saying banks want you in debt doesn't mean all debt is bad. Debt can be extremely useful. A mortgage can allow you to buy a home without having hundreds of thousands of dollars sitting in cash. A business loan can allow a company to buy equipment and expand. A student loan can finance an education that increases future earning potential. Debt becomes dangerous when the thing you're borrowing for doesn't generate enough value to justify the cost. That's the distinction. Good debt isn't debt that makes you feel rich. It's debt where the expected benefit can reasonably outweigh the cost and risk. And bad debt often does the opposite. It allows you to consume tomorrow's income today. A new car, a vacation, a television, a designer purchase, a dinner, a phone. None of these things are inherently evil. But if you're still paying for them months or years after the excitement is gone, something has changed. You're no longer buying the thing. You're buying it with your future labor. Here's a useful way to think about the entire relationship. Imagine you and the bank are playing the same game, but you're playing for different outcomes. The bank wants predictable payments, interest income, low default risk, long-term customers. You want low interest costs, financial flexibility, increasing net worth, and eventually, freedom from payments. Notice something? Your goals aren't perfectly aligned. That's not because the bank is evil. It's because you're on opposite sides of the transaction. A lender wants to earn a return on capital. A borrower wants to minimize the cost of accessing that capital. That's just business. The mistake is assuming the institution providing you the money is automatically acting like your financial advisor. It's not. If a bank approves you for a $50,000 car loan, that doesn't mean you should buy a $50,000 car. It means the bank has determined that lending you the money is acceptable under its risk model. Those are completely different questions. The bank is asking, will this person probably repay us? You should be asking, will taking this loan make my life better? And this brings us to something even more interesting. Your credit score. Credit scores are incredibly useful. They help lenders estimate risk. Someone with a strong history of paying debts is generally more attractive to a lender than someone who repeatedly misses payments. But there's an irony here. The financial system can reward you for demonstrating that you know how to borrow money responsibly by giving you access to even more money. That's not necessarily bad, but you need to understand what the system is actually measuring. A credit score isn't a wealth score. You can have an excellent credit score and a terrible net worth. You can have a low debt balance and little credit history. You can have a six-figure income and live paycheck to paycheck. And you can have millions in assets without needing to borrow very much at all. Credit worthiness and wealth are different things. One measures how attractive you are to lenders. The other measures how financially independent you actually are. Don't confuse the two. Now we get to the part that most debt conversations completely miss. Interest isn't just money you lose. It's money you can't use somewhere else. Imagine you have $500 every month available for your financial future. You could use it to pay down expensive debt, or invest it, or build an emergency fund, or start a business, or save for a house. But if you've committed that $500 to debt payments, those choices disappear. That's the opportunity cost. Debt doesn't just take money from you. It takes options. And options are incredibly valuable. Because the person with no monthly debt payments can make decisions that the heavily indebted person can't. They can quit a bad job, move to another city, take a lower-paying opportunity, start a company, handle an emergency, invest during a market crash, take time off. The person with $5,000 of fixed monthly obligations doesn't have the same freedom. This is why becoming debt-free can feel strangely different from simply having more money. You're not just increasing your bank balance. You're increasing the number of things you can say yes to. But here's the twist. Banks aren't the enemy of your financial life. They're infrastructure. Modern economies depend on lending. Without credit, buying homes would be harder. Businesses would have less access to capital. Consumers would have fewer financing options. Economic growth would look completely different. The problem isn't that banks lend money. The problem is when consumers forget what borrowing actually means. A loan is not free money. A credit limit is not income. A pre-approved offer is not a recommendation. And being able to afford the monthly payment does not necessarily mean you can afford the purchase. Those distinctions sound obvious, but entire industries make billions from people forgetting them. So the next time your bank offers you a bigger credit limit, don't immediately think, they trust me more. Think, they believe I can generate profitable payments for them. When a dealership says, we can get your payment down to $399 a month, don't just ask, can I afford $399? Ask, how much am I paying in total? When a credit card company offers you $20,000 of available credit, don't think, I have $20,000. Think, I have the ability to borrow up to $20,000. Those are radically different statements. And when you're considering a loan, ask one question before anything else. What am I getting in return for taking on this future obligation? If the answer is an asset, an investment in your earning ability, or something that meaningfully improves your financial position, the debt may be rational. If the answer is simply, I want it now, that's when you should slow down, because the bank has already done its math. Now it's your turn. The goal isn't to never borrow money. The goal isn't to hate banks. And it certainly isn't to believe that every loan is a trap. The real goal is to understand the game well enough that you're making the decision instead of the payment schedule making it for you. Because every dollar you borrow today is a dollar of future income you've already promised to someone else. And the more of your future income you promise away, the less freedom you have left. Banks make money from money moving. They make money from loans being repaid. They make money from interest. And that's their job. Your job is different. Your job is to build a financial life where you eventually need less of their money and more of your own. Because the ultimate financial flex isn't having a massive credit limit. It's reaching the point where you don't need to use it. The bank wants you to qualify for debt. You should want to qualify for freedom. And those two things aren't always the same.